All right, let's start off with this. The idea of buybacks topping $1.1 trillion. What does that say about companies and their outlook for not only their business, but the broader markets for the rest of the year?
Well, I think it's good for the broader markets because buybacks, as strong as they are, they're going to accelerate. It says that there's not a lot of great places for companies to invest in their businesses, so they're returning capital to shareholders.
So you're saying that this signals that companies don't believe they have a lot of great places to invest, but isn't every company investing in AI? Why is it a better decision to buy back your own stock as opposed to building out your AI capabilities, investing in data centers, things like that, things that are generally seen as a way to improve margins?
They're doing some of that with their cash flow that they're getting in from their businesses, but in terms of financing, they are leveraging up their companies through the bond market and using those proceeds to buy back stock.
All right, so we mentioned this in the intro. It's big tech companies like Apple and also the big banks really leading the buybacks. Are you expecting to see other areas of the market, maybe industrials, materials? I'm not really sure. Small caps. Are you expecting to see them also increase their buybacks, or will it continue to be led by big tech and financials?
Well, small caps don't have access to the bond market, so they're not going to buy back a lot of stock. But in general, the biggest companies do the biggest buybacks. S&P has an index of the 100 largest buyback companies. And that's been underperforming for 4 months. So they're buying back their stock and investors are taking the money and running. They're putting it into safer names or they're shorting stocks.
Yeah, we have seen a lot of shorting this year. I want to go back to the idea of buybacks being a big tailwind for the market. We actually had Lauren Goodwin from New York Life on yesterday, and she mentioned that their company, they do kind of a study of black swans, and they said one black swan would be the pace of buybacks slowing down significantly. She actually sees a lot of potential for that to happen going into the end of the year, and maybe even this administration doing something to limit buybacks. Do you see that potential risk when it comes to buybacks as well?
Well, the last administration tried to limit buybacks, and they've gone on to record, so that's not going to be a big factor. The buybacks are driven by U.S. public pensions, the biggest global investor. They are underfunded, and they are bringing in fresh new tax money and allocating it to credit. So the pension trustees vote in advance to put money into credit. The last 3 months have seen a record amount of pensions intending to allocate to credit. That's going to hit the market over the next 3 to 12 months. And we see them doing even more going forward in the fourth quarter. So I think the risk of a slowdown in buybacks is very, very small unless stocks get overheated. That's when the buybacks slow down, and that's when you get a correction. But we're not at that point yet.
Well, Brian, really quickly, because I'm kind of going back to one of my first questions. I mean, the market's not overheated now because it just seems like even though the markets are at highs right now and a pretty high valuation, again, you said buybacks don't seem to be slowing down. Isn't this kind of the place where we're frothy or overheated, whatever phrase you want to use?
No, we're only one standard deviation above the trend of this bull market. It's when we get to 2 standard deviations above trend. That's when stocks get overheated, and that's when the buybacks fall off for a little bit, and that's when you get the correction.